welcome to The Explainer. You know, every single time you tap your phone screen to order that Friday night biryani, you're actually casting a vote in a massive 50,000 crore rupee food tech war. Today, we're pitting Zomato and Swiggy head-to-head, digging into the numbers to see which of these stocks really delivers. So here's our roadmap for today's Explainer. We're going to cover 5 key areas. First, the food tech duopoly. Then we'll look at their financials, profit versus burn, before diving into the quick commerce battleground. After that, we'll weigh their valuations and risk profiles, and finally wrap up with the shared threats they both face. All right, let's jump right into part 1, the food tech duopoly. Looking at the organized food delivery market right now, Zomato is commanding a pretty dominant 58% share, which leaves Swiggy sitting at 42%. Now, in a business where every penny and every minute of logistics absolutely matters, a 16 percentage point gap, that's not just a lead, it's practically a canyon. It gives Zomato some serious network effects, way better bargaining power with restaurants, and really unmatched operational leverage. And what's wild is that back in 2020, these two were at near parity. But since then, their playbooks have completely diverged. Zomato is really playing the empire builder here, pushing aggressively into Tier 2 and Tier 3 cities just to capture sheer volume. Swiggy, on the other hand, is acting more like the agile challenger. They're banking heavily on user experience and that high adrenaline promise of 10-minute delivery to build some seriously fierce brand loyalty. Moving on to Section 2, let's talk about financials, profit versus burn. Tracing their history back a bit, a major inflection point happened around Zomato's 2021 IPO. That public offering acted as a massive war chest for them. It fueled aggressive customer acquisition and really accelerated their restaurant partner expansion. That huge capital advantage basically widened the market share gap around 2023, and it ultimately paved the way for Zomato's landmark achievement, hitting sustainable profitability in FY24. And those divergent strategies, well, they've led to some staggering financial differences. Based on FY25 estimates, Zomato is growing at a blistering 67%, with their top-line revenue crossing the 20,000 crore mark. But honestly, the real headline here is their bottom line, a 527 crore rupee profit. Meanwhile, you've got Swiggy growing at a much slower 35% clip, with revenues around 15,000 crore, and they're still deeply entrenched in a really costly investment phase. To put Swiggy's investment phase into perspective, they reported a staggering annual loss exceeding 3,117 crore rupees. That is a whole lot of cash to burn through. But it's quite simply the price of trying to keep up with Zomato's massive scale. They're basically paying a severe short-term cost, aggressively pushing into new verticals in a somewhat desperate bid to buy long-term market relevance. Which brings us perfectly to Section 3, the quick commerce battleground. Quick commerce, getting your groceries delivered in literally 10 minutes, is notoriously capital-intensive. Yet Zomato's subsidiary, Blinkit, is sitting at a near break-even EBITDA margin of negative 0.1%. Just as a quick refresher, EBITDA margin basically tells us how much operating cash a company makes as a percentage of its revenue, before taxes and all those accounting quirks. So a negative 0.1%, that means Zomato has practically solved this incredibly tough unit economics puzzle. Meanwhile, Swiggy's Instamart is bleeding cash at a negative 11.7% margin. So for every 100 rupees Swiggy makes here, they're losing significantly more than Zomato. And you know what? The margins only tell half the story. Zomato isn't just leading in efficiency, they are absolutely dominating the actual order volume. Blinkit holds nearly half of the entire quick commerce market at 46%, while Instamart is lagging pretty far behind at just 25%. On a daily basis, Blinkit delivers about 3.6 lakh more orders. Zomato's massive lead here is really forcing Swiggy's hand, making them spend heavily just to stay relevant in the conversation. All right, let's translate all this into Section 4, valuations and risk profiles. The market's verdict here is actually loud and clear when we look at their price-to-sales ratios. This is a metric that shows how much investors are willing to pay for each rupee of a company's sales. So Zomato is currently trading at a premium 12.2 ratio. Investors are happily paying up for that proven profitability and market dominance. Swiggy, however, sits at a 6.0 ratio. That massive 45% discount signals some pretty clear market caution. But hey, for a bold investor, it also represents some immense upside if Swiggy can actually pull off a turnaround. Like a lot of analyst reports suggest, your choice between the two depends almost entirely on your personal risk appetite. Are you looking for a proven, stable business model that's already generating steady cash? Or are you hunting for a high-growth, high-risk turnaround play where a successful strategy shift could drastically re-rate the stock upwards?
Let's wrap things up with Section 5, Shared Threats and the Future.
Regardless of who is winning right now, both of these giants are navigating a landscape just filled with existential challenges. First up, you have the rapid rise of incredibly fierce competitors like Zepto, who are aggressively expanding their own quick commerce footprint and eating into that market share. Second, there's the looming shadow of the government's ONDC network. That initiative aims to democratize e-commerce and could theoretically strip away the platform-dominant Zomato and Swiggy enjoy today. And finally, there are severe regulatory risks, things like dark store licensing and the ever-present debate over the classification of gig workers. A single regulatory shift there could drastically alter their operating costs literally overnight. But here's what you should really take away from all this data: the sheer size of the prize they're fighting for. Right now, Indian food delivery penetration is at just 7%. When you compare that to the 35 to 50% penetration we see in developed markets, you realize there is a massive, untapped runway ahead for whoever actually wins this war. Both of these companies are battling for a future market that's going to completely dwarf what we see today. So, I'm going to leave you with this final thought to ponder. When you're looking at investing in the future of Indian food tech and you see the completely distinct paths these two giants are taking, do you bet your money on Zomato's profitable, premium price leadership? Or do you take a chance on Swiggy's heavily discounted high-reward turnaround potential? Thanks for joining me for this explainer, and as always, keep questioning the data.